The multiples valuation is a valuation every investor should know, as it compares a company's competitors to the company you are trying to evaluate, and so gives you great insight whether the company you are looking at is worth buying compared to its sector, as all sectors and industries have very different standards. And so today we'll have a look at how to carry out this evaluation in Google Sheets, as well where and how to correctly choose the competitors so that the evaluation comes out as correctly as possible. So first let's create the evaluation sheet, and for those of you who want to recreate it, I will add all the formulas below in the video description. So the first thing we want to do is create a cell where we will be inputting our ticker symbols. And right below that cell, we will input a Google Finance formula where we'll input the cell for me H3, and we will put parentheses, and between the parentheses we'll put the word name, and that will display the name of the company we are trying to evaluate based on the ticker symbol. And of course, if you want to download all these automatic valuation spreadsheets, which I use to calculate the intrinsic value of all the companies in my videos, you can do so at my Patreon in the link in the description. And with that, let's get to understanding the multiples valuation. So the way the multiples valuation works is that we take the competitor and we take their stock price, we divide by their earnings per share and get their PE ratio. Now if you look closer, you will see that when you take the PE ratio and you take the earnings per share, you will actually get the stock price of the company back. And that's the way we calculate the intrinsic value of our company. So we take the competitors' stock prices and divide by their earnings per share and get their PE ratios. We then average out their PE ratios, which you can see right here, and multiply by the earnings per share of the company we are evaluating to get the intrinsic value. Now in simpler terms, whenever the average PE ratio of the competitors is higher than the PE ratio of the company we're trying to evaluate, the intrinsic value will come out higher than the current trading price of the company, as the competitors are spending more to get profit. Now that we understand how the multiples valuation works, I'll show you how to create it in Google Sheets to be fully automatic. So we will again create spaces or cells for our competitor ticker symbols to go to. As you can see, I will do the example on WMT. So WMT, the next cell again will be a cell with the Google Finance formula where we will input the cell D13, that's the cell with the ticker symbol for my competitor, and again in parentheses we'll put the word name. Now in the next cell we will again use the Google Finance formula and input the cell D13, again the ticker symbol with our competitor. And the next cell, the earnings per share of the company, so again the same cell, and in parentheses we will put EPS or earnings per share. And now for the final cell, the PE ratio, we will simply take the stock price and divide by the earnings per share to get our PE ratio. And after you have finished the first row, you can simply select it and drag it all the way down to recreate for the other rows. Now I usually compare my companies to 2 to 3 competitors, but if you want to add more rows, you are completely free to do so. Now let's calculate the average PE. So I use this formula and input the sum of the prices to earnings per share for all 3 companies. And if you want to use a normal average formula, you are completely free to do so. It will not change anything. This is just a little more fancy. Now that we have the average PE, we can pull the earnings per share for target, again using the same Google Finance formula as we used to pull the earnings per share for our competitors. And to pull the current price of target, we will use the same formula again as we used for our competitors, except we'll input the cell H3, which is where our target ticker is located. And then to get our intrinsic value, it is very simple. We'll just multiply the average PE, the cell where the average PE is located, with the cell with the earnings per share of target, and we get our intrinsic value. But now we can get to actually carrying out the multiples valuation. So I already do have 2 companies right here, but how did I choose them? How did I choose them properly to correctly compare to target? Well, there are a few rules that I like to follow, which I will show you in a bit, but first we have to understand where we can find the competitors. And the best free way is to head over to Seeking Alpha, where you will simply plug in the ticker symbol of the company you are trying to evaluate, and you will navigate over to the Peers tab where all the competitors will show up. Now, when it's possible, always try to choose a company that has the most similar market cap to the company you're trying to evaluate, target in this case. Another very important rule I like to follow is that when the company you are evaluating pays out dividends, the company you are comparing it to has to pay out dividends as well. Otherwise, the comparison might be biased. So for example, let's have a look at BJ Wholesale. We will type BJ stock into Google and scroll a little down, and we can see that they do not pay out a dividend, so we will not use them for our multiples valuation. Now let's jump back to our multiples valuation, and as you can see, I am comparing Target to Walmart and Dollar General. Now another very important rule you have to follow is that when one of the competitors have negative earnings per share, you cannot use them. So let me plug in MPW for example and watch what happens with the intrinsic price. When we press enter, the intrinsic value goes down. Now normally the intrinsic value should have gone up because MPW is essentially going into debt, which would mean that Target has higher earnings per share. But as our average takes the negative as a low number, the average PE goes down, and therefore when you multiply the average PE with the earnings per share, the intrinsic value comes out less than if we weren't to have this company. So don't use companies with negative earnings per share as it messes up the valuation. So now we are fully ready to carry out the evaluation. So we will plug in the ticker TGT for Target, we'll plug in our competitors, we'll take their stock prices and divide by their earnings per share and get their PE ratios, which we will average out and multiply by the earnings per share of Target to get an intrinsic value of $210.45. And this shows us that Target might be undervalued compared to its competitors' earnings. And this is essentially all you need to know when carrying out the multiples valuation. So if you did enjoy the video, if you found it helpful, make sure to let me know down in the comments. So if you did enjoy the video, if you found it helpful, make sure to leave a like and subscribe as it really helps me out. Also let me know down in the comments which company you'd like me to evaluate using multiples valuation.